Deemed over. All right, still not over. We're still a few minutes away from finding out for sure a Fed decision, the latest one here as to whether to raise rates or not. Doesn't look like a decision will come from this meeting to do that, but Fed officials could be targeting maybe one for 6 weeks from now to market watcher Scott Martin on what to expect. If indeed they do hint of a rate hike the next go-round in 6 weeks, it would put overnight lending rates north of 1%. Now, that still seems, paltry by almost any measure, but it will continue an upward direction. Do you see that continuing?
I do, Neil. It sounds crazy, though, doesn't it?
Right,
right. Where are the days of the zero interest rate, ZIRP policy, as it was called, ZIRP, zero interest rate policy? Because I'll tell you, man, nowadays the Fed is back in play. But I got something weird to tell you. I almost feel like the market had this burning desire for the Fed to come out and say, hey, everybody, the economy's good enough, the markets are healthy enough, we can move off of zero, we can lighten our balance sheet, we can let interest rates get back to normal. Just after, say, a year and a half ago when the market was freaked out by the Fed raising interest rates, it's in a lot better position today.
The Federal Reserve, I know it's stuck on raising rates and unwinding all of this, this balance sheet, I guess, trillions worth. But what if they're maybe ignoring the latest data, which seems to hint that whatever robust economic activity they saw picking up steam isn't? I mean, latest jobs numbers have been softening. Some of the numbers we're getting out of the auto giants show a lessening in sales here. What is going on, and is the Fed attuned to that? What do you think?
Yeah, I mean, how about personal income and spending numbers too, Neil? Those have been really disappointing. I mean, those have actually been a pretty good head-scratcher with respect to the jobs numbers. The Fed is in an interesting spot because you're right. They need to pay attention to all sorts of economic data, but I think most importantly to recent data points as they change and as things kind of ebb and flow. And so you could see the statement today, Neil, look a lot like, say, the statement we saw in March. But as it portends to what happens in June and further on is really the key here, because I believe the Fed wants to start normalizing rates, which means that at some point they're going to get back to that 2, 3, 4% range. And they do that by starting the hiking process again, or restarting it, let's say, in June of this year.
All right, so if it's 3 or 4 rate hikes a year, it would take, a few years to get to that norm, right? I mean, a couple of years at least.
Exactly. And I'll tell you what's interesting. I actually believe the market would like that. I think the market expects this. And any deviation from this new course that the market is expecting, which is higher interest rates, could be a hiccup for the stock market.
One thing, and maybe you help me with this, long-term interest rates that have nothing to do with what the Fed can control, obviously they could set the stage, they've been rather flat, and in fact coming down, even in the face of promised stimulus from Washington. Is it the market's way, the bond market's way of saying we don't see it happening?
Yeah, I mean, the tax cut progress has obviously slowed, or at least, say, dimmed a little bit. And I think, too, Neil, the infrastructure spending plan, right? Because as you create that trillion-dollar infrastructure spending plan, you're going to issue more debt that would typically, affect interest rates. So I think the market is saying, hey, we don't totally believe that this idea of the tax cuts and all these growth policies that we've been promised now for months are going to come through.
All right. We'll see. Scott Martin will have that decision in just a few minutes, or the non-decision, but paving the way for something about what they want to do in the future. Meanwhile,